You know what's wrong with most volume indicators? They show you volume spikes, but they never tell you if the market actually has enough participation to sustain a move. By the time you realize the volume was fake, you're already trapped in a low liquidity nightmare. And that's exactly why you need to see this secret indicator that transforms dollar volume into an activity meter that never lies. In this video, I'm going to reveal this indicator to you, show you the perfect settings, and give you 3 powerful strategies you can start using today to add this indicator to your chart. First, head over to TradingView and pull up any chart you want. I'm using the 15-minute time frame on euro-dollar, but this works on any market. Any time frame, click on indicators and type in Trading Activity Index. Make sure you select the one by Zierman. Now, this isn't your regular volume indicator. No, this is much better. Most indicators just show you bar volume or total volume traded, but this one, it transforms dollar volume into a smooth, normalized activity index that tells you exactly when market participation is unusually low or high. Let me show you what makes it really special. You've got the main activity line that changes color, light blue for low activity, red and orange for high activity, but that's not all. See these percentile bands at 20%, 40%, 60%, and 80%? They give you instant context about whether current activity is in the bottom, quintile, mid-range, or near historical extremes. The indicator computes dollar volume, that is, price times volume, then log transforms it to compress outliers and smooths it with a configurable window. Then it ranks this against rolling history using percentile calculations, giving you a normalized 0 to 1 score that colors the activity line. So when you see light blue, you know participation is thin and liquidity is low. But when you see red or orange, you know active markets with large institutional trades are flowing in. This is like having X-ray vision into market participation. Now here's the truth. Most retail traders never figure out. You can learn every manipulation setup I just showed you, but if you're manually staring at charts, you'll always be the last one in and the first one out. That's exactly why we automate everything: entries, exits, and risk management. Our traders run these exact setups fully automated across forex, crypto, and indices, and the results speak for themselves, like Ethan, who got funded 3 different times using these systems, or Marion, who made $10,000 in just 10 days while still working full-time as a chef. These aren't what-ifs, they're real results happening inside our community every single day. If you want to see the live performance results and backtest data for yourself, click the first link in the description before the spots close. Disclaimer: this is for educational purposes only. Trading carries risk, and no strategy can guarantee results. Now, to get maximum accuracy with this indicator, let's get your settings right. Double-click on the indicator to access the settings panel. You'll see the formation window, which controls how many bars are used to average dollar volume before the log transform. I found that setting it to 50 gives you a perfect balance between smoothness and responsiveness, filtering out single bar anomalies while still catching genuine activity shifts. Next, adjust the history window, your look-back period for percentile calculations. Set it to 200 bars to give the algorithm enough historical context to properly rank current activity without including outdated market regimes. Once you've adjusted these settings, click OK. Now let me show you the first way to use this tool: detecting high-impact sessions. This is your foundation for filtering setups that need activity to work. The key is simple. You want to see if today's session is active or quiet, relative to its own history. So when the activity line is above the 60th percentile and colored orange or red, you know you're in a high participation environment. This is perfect for breakout trades and momentum strategies because there's enough liquidity to sustain moves. Look at this example here. The activity index is sitting at the 75th percentile, deep orange color. This tells you institutional traders are active, large orders are flowing, and the market has the fuel to trend. In contrast, here is an activity below the 20th percentile, light blue color. This is a quiet session with thin participation. Any breakout here is vulnerable to fakeouts because there's simply not enough volume to validate the move. The rule is simple: don't ever trade momentum and breakouts unless the activity line is above the 60th percentile. This one filter alone will save you from countless low liquidity traps. The second way to use this indicator is my favorite, which is by combining it with price action to spot real breakouts versus fakeouts. Most traders fail to understand that not all breakouts are created equal. A breakout on low activity is just price drifting through empty space. It has no institutional backing. But a breakout on high activity, that's smart money positioning. Look at this setup. Price breaks above resistance here, and when you check the trading activity index, it shows 82nd percentile, bright red with maximum participation. This tells you the breakout has real conviction behind it, which means institutions are lifting offers aggressively, volume is surging, and the move is validated. Now look at this false breakout. Price pushes through the level, but the activity index is at the 15th percentile, light blue with minimal participation. This means retail traders are chasing while institutions are sitting on their hands. Minutes later, price collapses back below the level, stopping out everyone who trusted the breakout. You want to trade breakouts only when activity is above the 70th percentile. percentile. If activity is below the 40th percentile during a breakout, fade it or wait for the inevitable retest of the breakout point. This separation between real and fake breakouts is what puts you in the top tier of traders. Now for the final piece of the puzzle, using percentile bands to assess market regime. This is where the Trading Activity Index becomes a complete trading system. The percentile bands help you understand whether participation is building up in the middle of the range or drying out. When the percentile band is above the 85th percentile, red and orange zones, you know the market is highly active. This is when breakout trades and trend-following strategies work best because there's institutional participation driving moves. Look for continuation patterns, momentum setups, and ride the wave. And when the percentile band is below the 20th percentile, light blue zone, you know the market is quiet and liquidity is thin. This is when you fade moves or wait for expansion because any directional trade you take is fighting against low participation. Mean reversion strategies especially work better here because high activity favors momentum and low activity favors patience. Here's what separates profitable traders from everyone else watching this video. Retail keeps chasing breakouts and getting dumped on, while institutions pocket the profits. You can master every manipulation strategy I just showed you, but if you're trading manually, you'll burn out long before you ever get consistent results. That's why we built automated systems that hunt these manipulation moves 24/7. No emotions, no missed setups, just results. Over 600 traders are already using these exact systems, like Dan, who made $9,000 in his very first month, or Steven, who shows consistent overnight profits while he sleeps. But I only take on 30 traders each month because I personally guide everyone through setup to make sure you're getting results. So if you're serious about finally trading with the institutions instead of against them, click the first link now before spots fill up. Disclaimer: this is for educational purposes only. Trading carries risk, and no strategy can guarantee results. Now, different markets require different settings for maximum accuracy. For forex pairs, especially majors like euro-dollar and pound-dollar, set your formation window to 60 bars and history window to 250 bars. Forex markets have consistent institutional flow patterns that require slightly longer look-back periods to properly contextualize. For crypto, drop the formation window to 40 bars and bump the history window to 300 bars. Crypto has more volatile participation patterns with rapid shifts between high and low activity periods. The shorter formation window catches these transitions faster, while the longer history window provides better context for extreme readings. Only trade directional moves when activity exceeds the 75th percentile in crypto. Anything less, and you're fighting against erratic retail-driven chop for gold. Set formation window to 55 bars and history window to 200 bars. Gold has unique volatility characteristics with sharp institutional positioning during specific sessions, particularly London Open and US Market Open Watch for activity spikes above the 85th percentile during these times, as they often precede significant directional moves. Thanks for watching, and I'll see you in the next one.